And we are back live with another podcast installment with yours truly, the Algo Capitalist, aka the Vulcan, coming to you live from postwavetrading.com, home of the world famous postwave price trigger reports. And this is our special podcast, Thinking Outside the Bots. And yesterday we talked about the banking crisis, the banking issue, and we have seen another bank get bailed out, this time by JP Morgan acquiring the bank. So the question that is looming, other than the FOMC rate decision tomorrow, is how many more banks are there to come? Which one will be the next shoe to drop? Now, the Fed funds rate futures is pricing in a quarter basis point rate hike tomorrow. That is what they're anticipating. I believe, like I said in last night's video, and I did warn you in case you forgot or you didn't hear the podcast yesterday, I warned and I said that last night's end of day report was going to be critical, crucial. Turns out I was correct. If you just woke up, you'll notice that the Dow was down over 500 points, the S&P down almost 60 points, the NASDAQ down over 125 points, the Russell down 43 points. The markets are just dropping like a rock. And this is ahead of the FOMC tomorrow. Now, throughout market history, I'll take you back to 1999. How about that? Since 1999, the Fed day reports, announcements, speeches, press conferences, etc., have always been a market moving event. And then we had a situation where things kind of cooled off in the 2010s. FOMC day really didn't mean anything. But prior to 2010, you couldn't trade ahead of or during the FOMC unless you just wanted to get your face ripped off, because that's how volatile the markets were. Nothing like today. But it seems that those days are slowly returning almost, because the amount of volatility that we're starting to see in some of these markets is reminiscent to the late 90s, early 2000s. Case in point, in last night's video, I showed you how silver rallied and then crashed into the close. Well, it did something close to that again today. Silver opened at $25.25 an ounce, looking at the July futures contract. It proceeded to rally to, it then dropped to $24.82, then quickly reversed and exploded to $25.76, or should I say 76 and a half cents. Now, currently, it's at $25.63. So very powerful price swings in these markets. Not only that, but if you take a look at the S&P, Dow, NASDAQ, and the Russell, they had an explosive bear market rally that popped and took out the prior highs and resistance zones, only to collapse today. So you could look at that as a stop run, because there were a lot of institutions short. Even I was short. And you could see how the market ran up, went to those areas, and then immediately vacated those resistance zones. And now the markets are rolling over and falling out of bed ahead of the Fed. So you have to ask the question, what is going to be the outcome tomorrow? Well, traditionally, when we had situations where we were coming up into a Fed announcement, it was reasonable and customary at the time that the market would rally into the Fed announcement. And then once the announcement comes out, then the market rolls over. Other times, the market would do like it's doing today, crash into the announcement. And then as soon as the announcement's made, the market would explode higher. So, based on those norms, you would think that as the market is falling ahead of the FOMC, that means tomorrow, the market's preparing itself to rally. The reason why I do not prescribe to that train of thought for tomorrow is because we just took out a major resistance area yesterday. All right. And the day before. Key areas only to retreat. Normally, leading up into the Fed announcement, you're going to hit new highs or lows, and the market does that after the announcement. All right. So if you have a rally or a crash into the announcement, it's not taking out any major resistance or support areas prior to an announcement. It waits for the announcement to do that. But instead, this market, this time around, has decided to take out these areas going into the announcement. So going from a historical perspective, we usually get a major continuation pattern after the announcement. So being that you got the Dow and the S&P and the NASDAQ and the Russell all down sharply today, chances are that after the announcement tomorrow, the market's really going to sell off. That would be the historical precedent for what we are seeing in the price action today. So I wanted to just throw that at you so you could understand what we're looking at here and what we're talking about. Now, it doesn't mean that the market can't rally, just that the precedent leading to these events shows that if you take out a key support or resistance zone prior to the meeting, the day prior, then the market is going to continue in that regard once the announcement comes out. If you just have a rally or just a sell-off, but you don't take out any major areas leading up to the report, then the market like to quickly reverse. All right. This is not that. We're not looking at a reversal for tomorrow. We're looking at a continuation pattern of today's sell-off. Now, we came into today, and I showed you in last night's video the various rally and crash alerts that we had coming into today. And the Dow definitely gave us a crash alert for today. And of course, the Dow is falling. And I also showed you that a majority of these markets also were in a bear market or had a bearish trend momentum reading. And like I've shown you also in the past, that when you have a trend momentum reading that is contrary to the trend, the overall trend of the market, those are where your biggest moves happen: flash crashes, explosive rallies, etc. Anything that happens in the market always happens in the trend momentum zone that the market is currently in. And that's what we have. So we still have a lot of these markets that are in those areas that are bearish. So we come into today with this information. Now, another thing that should be stated is that there were some key economic factors that a lot of the Wall Street analysts, even some of the analysts that I respect and follow, They were concerned about some economic activities. And they said if we saw these things come to pass, then it will spell disaster, not just for the economy, but for the markets too. And like I was saying to you in yesterday's podcast, we're looking at death by 1,000 cuts. And yes, I know we talked about it yesterday as well. Our leaders were able to successfully kick the can down the road for a long time, for 2 whole decades. But now, many of our long term problems are becoming short term problems. And the economic outlook for the remainder of 2023 is extremely bleak. None of the economic hardships that we are experiencing at this moment should shock or surprise any of us. The truth is that we were warned about all these things well ahead of time. Many independent voices have been warning us, me included, that there would be severe consequences for the exceedingly foolish economic decisions of our leaders. They made some dumb decisions, and now those severe consequences are starting to play out right in front of our eyes. Let's take a look at some of these economic disasters that we were warned about that are happening, that are transpiring right now. The first one is that we were warned that a great commercial real estate crisis would be coming, and now it's here. With recent stress in the regional banking sector, sentiment in the U.S. commercial real estate and especially the office sector has turned negative as investors prepare for potential spillover effects, with JP Morgan and Morgan Stanley and Goldman Sachs all joining the gloom parade, especially as high-profile defaults continue to make headlines as borrowers face higher debt service costs and refinancing becomes much harder ahead of a $400 billion CER debt maturities this year alone. Now, the latest headlines that are fueling concerns about a potential CRE crisis involves a fund belonging to the CRE giant Brookfield defaulting on a $161.4 million mortgage for 12 office buildings in Washington, D.C. According to Bloomberg, the loan was transferred to a special service worker with the borrower to execute a pre-negotiation agreement and to determine the path forward. Again, we talked about it before, it was mentioned, and here it is. We got a real estate crisis in the commercial real estate sector. Another thing that we were concerned about and were warned that there would be widespread layoffs as economic conditions in the United States deteriorated. Sadly, this is now happening all around us. Yeah. Think about it. Even Ernst and Young have laid off at least 3,000 workers, which is 5% of the firm's workforce. When you're laying off an accountant, you know hard times are here. What's another thing we were warned about? Oh, and by the way, we talked about it yesterday. The Fed wants even more layoffs. The government, the federal government, wants you to lose your job. And they're saying this is the only way that they can fix the inflationary problem that we are facing. Well, we were also warned that the largest corporate debt bubble in the history of the world would eventually burst. And now corporations are beginning to default on their debts at a rate that should deeply alarm everyone. More companies around the world defaulted on their debts in the first 3 months of this year alone than in any quarter since 2020, when businesses were still hamstrung by restrictions to stop the spread of a virus. In a report, credit rating agency Moody's said 33 of the corporations it rates defaulted on their debts in the first quarter, the highest level since the last quarter of 2020, when 47 companies defaulted. Almost half, or 15 companies, defaulted just a few months ago, which is the highest monthly count since December of 2020. Defaulting firms included Silicon Valley Bank, which collapsed in March, its holding company SVB Financial Group, and Signature Bank. And like I said in the beginning of today's podcast, what are the next shoes to drop? What are the next banks? Well, we were also warned that we would witness a dramatic surge in bankruptcies in 2023, and that is precisely what is happening. Bankruptcy filings across the United States rose for the third straight month in March in all major industries. Not some, but all major industries. A total of 42,368 new bankruptcies were filed last month, according to the data firm Epic Bankruptcy, a provider of U.S. bankruptcy court data, technology, and services. This is 17% up from the 36,068 filings in March of 2022 and is the highest number of monthly bankruptcy filings since April of 2021. Data from the S&P Global Market Intelligence showed 71 corporate bankruptcy petitions in March, a jump from 58 in the previous month. This is the highest monthly total since July 2020 and the fourth straight month of increases. Finally, we were warned that the rest of the world would eventually start rejecting the US dollar, and now de-dollarization is happening at a stunning pace. The dollar is losing its reserve status as a faster pace than generally accepted, as many analysts have failed to account for last year's wild exchange rate moves, according to Stephen Jen. The greenback share in global reserves slid last year at 10 times the average speed of the past 2 decades as a number of countries look for alternatives after Russia's invasion of Ukraine triggered sanctions. Jen and his Eurozone SLJ Capital Limited colleague Joanna Fryer wrote in a note, adjusting for exchange rate movements, the dollar has lost about 11% of its market share since 2016 and double that amount since 2008. The dollar suffered a stunning collapse in 2022 in its market share as a reserve currency, presumably due to its muscular use of sanctions. Jen and Fryer wrote, exceptional actions taken by the U.S. and its allies against Russia have startled large reserve holding countries, most of which are emerging economies from the so-called global south, they said. Now, unfortunately, we're still only in the very early stages of this economic meltdown. The general population is starting to understand that things have gone horribly wrong. And a CNBC survey that was just released discovered that Americans have never been more negative about the economy than they are at this very moment. Amid persistent inflation, higher interest rates, and recession worries, Americans have never been more negative about the economy, according to the latest CNBC All American Economic Survey. A record 69% of the public holds negative views about the economy both now and in the future, the highest percentage in the survey's 17-year history. Even during the darkest days of 2008 and 2009, Americans were more optimistic about the future of the economy than they are right now today. Think about that. The United States of America is in really, really deep trouble. Of course, this new economic crisis that the country finds itself in now will take some time to fully play out, but it has officially arrived. The months ahead are going to be filled with economic pain, and that's going to cause a tremendous amount of turmoil throughout our entire society. ladies and gentlemen, this is no joke. It's already official. The banking collapse of 2023 is now officially bigger than the banking collapse of 2008. That's right. I want you to think about that. That is crazy. So think about these things as we go into tomorrow's FOMC. Remember, they want you to lose your job. Okay? That's what they want. They want you to be laid off. And you got to ask yourself a question. Why is that? Because the explanation that they're giving, you and I both know is bogus. 100% absolute poppycock, foolishness, baloney. All right, that's all I got for you today. I just wanted to briefly go over a few things here ahead of tomorrow's FOMC. Yeah. Aaron in the live chat said that the new system is coming. Yeah. And like I said, back in 2013 on the late, great Charlie McGrath's Wide Awake News show, you're not going to like the new system. You are not going to like it because it's a control grid. You know, remember the guy that got banned off of social media, Alex Jones? Remember when he told everybody about the control grid? Remember the first time you heard control grid? Whether you like him or not, you cannot debunk the amount of evidence and information he gave you. And I have to tell you, man, he's looking like a prophet right now. He warned of a lot of things to come, and people thought he was crazy. Now, his personality can be over the top at times, but it still didn't take away from the content. The information that was being given out was right on point, man. And a lot of people did not take time to do anything about it, to prepare themselves. Even if you can't do anything about it, you at least want to be mentally prepared. You know what I'm saying? And a lot of people didn't take advantage of that either. A lot of people missed out on a lot of things, man. Seriously. Because they talked themselves out of stuff. You know, oh, it's nothing I can do or whatever. And that's not true. There's a lot that you can do. There's still a lot you can do now. You know, since they're taking your job away, take, whatever money you have, whatever nest egg you have, open a trading account and start capitalizing off of what's happening. That's the lifestyle of trading. We make money off of calamity. And there's nothing wrong with that. That's what supply and demand is. That's what we do. This is I told you at the beginning of the year that this was going to be one of the greatest times to be in the markets and make money, because there's so many markets you can do. Oh, thanks, Brandon. I appreciate that. Thank you. Well, I mean, look, it depends on a lot of things. Depend on a lot of different things. Like, for instance, it's going to come down to where you are, what state you're in, what the politics of your state are. There's a lot of different factors. It's not, and everything doesn't just come down all at once. The curtain is not just going to come down all at once. It's going to be a process, and it has been a process, and that process is going to continue. You just got to do what you got to do, and you have to make the proper decisions. I remember when I first came on the Wide Awake News show with Charlie McGrath, and we started talking about gold and silver, and I was explaining why the paper markets exist for gold and silver and platinum and palladium and copper, and why you should learn how to use it to your advantage. The reason the paper markets are there is for liquidity. So that if you are a stacker of precious metals, and let's say you need to raise capital because you have an unforeseen expense or whatever, instead of having to go and liquidate your physical, the paper market exists so that you can raise capital through the paper market without having to liquidate your physical gold and silver. That's why I've been encouraging people since 2013 to open brokerage accounts so that you can buy and sell, in the paper, physical metal markets, because that's how you raise cash without having to liquidate your physicals. So if the price of gold is falling, but you need to raise capital for an emergency, instead of having to go and sell your gold bars, you can short the gold paper market, take profit, and there's your money right there for your expense. Or vice versa with silver or platinum or palladium or copper, whatever it is. That's what the paper markets are there for liquidity, so that you don't have to relinquish your physicals. It's an amazing apparatus, and not enough people take advantage of it. Sad to say, not enough people take advantage of it, and you really should learn to take advantage of it and use it. And that's what the pulse waves are for. That's why I created the pulse waves, the pulse wave reports, to help people who, whether you have experience investing or not, or whether you've never placed a trade or not in your life, I take the rocket science out of it. I've done all the hard work. All you have to do is push a button. That's all you have to do. Read a report. Takes you about 5 minutes, and then place your trades. I even show you how to do that. I have videos showing you how to do that. And if you are just not able to do it, I have extended the hand, the helping hand, where I will do it for you. All you have to do is reach out to me. So I've taken away all the excuses. I know some people, I'm not that smart and I can't figure that stuff out. Well, that's what I'm here for. I can help you. You don't have to go it alone. But, I can only lead you to the water. I can't make you drink. And, I can't help you once everything has hit the fan. It's too late. The time for preparation is not in the midst of a crisis. It's before the crisis begins. So before things get really bad, you might want to go ahead and start making those moves. I've also told you the difference in the blessings of a brokerage account versus a bank is because brokerage accounts have to have segregated funds. That's why, you've been hearing about Charles Schwab. Now, Charles Schwab, the brokerage, is fine. They're good to go. But Charles Schwab, the bank, is in trouble. So it's different. The banking finance laws are totally different with brokerage accounts versus traditional bank accounts. So you gain a benefit from having a brokerage account over having a traditional bank account. And I've talked about that throughout the years here on YouTube. All right, so that's all I got for you, man. I'll see you guys here tonight. I think tonight's end of day report is also going to be very important, because now we're going to wait to see where these markets end up today, where they close. And I'm anticipating that it will be quiet until tomorrow afternoon when the FOMC is out, and then we'll really see some more fireworks. But for now, I think some of these markets, based on the moves I'm seeing today, the trend momentum readings may have switched in some of these markets. So, like in the Russell, it's been in a bear market. We had a bullish trend momentum reading. There's a strong possibility it's that the bear market has reclaimed the Russell. So I'm curious to see if that's the case and to see where we go from here. All right, folks, you know what it is, man. Smash the like button, and I'll see you in the next one. Peace.